A lot of what you're about to hear is likely to surprise you. It will probably change the way you invest. It certainly changed my approach. What follows is 100% free. It won't cost you anything. Pretty much everyone tries to save for the future, whether it's for a home, for their kids' education, or to ensure they have a comfortable retirement. But for the best results, you need to do more than just save. You have to invest. However, the investing world can be a complex and confusing place. My aim with OfWealth is to cut through the noise, make it easier to understand, and help you to be a successful investor. Let me introduce myself. My name is Rob Marstrand. I spent 15 years working inside one of the world's very largest global investment banks, based in London, Zurich and Hong Kong, but working across much of the world. During that time, I had privileged insight into the very best and worst that the financial industry has to offer. After that, I spent 4 years helping very wealthy families, mainly from the US and Europe, with their investments. Now I've struck out on my own. OfWealth is the result. Overall, I've learnt that many investors, even professional hedge fund managers, let alone private individuals, have major misunderstandings or important gaps in their knowledge. Filling in some of those gaps means more opportunity for profit. This presentation highlights 20 of the things that I've discovered. You may not like all that you hear, but I'm sure you will find it interesting and useful. These 20 facts will change the way you invest. Let's start with something about China. China's stock markets are already huge. Their total value is over $10 trillion. $3 trillion of that is from Hong Kong, a market that was founded in 1891. But the other $7 trillion comes from the mainland markets in Shanghai and Shenzhen, which opened in 1990. That was just 25 years ago. This means that the stock markets in China are already 40% as big as the USA, a tenth bigger than all of Europe and over twice as large as Japan. Before we know it, China's stock markets could overtake the USA's as the largest in the world, perhaps in another 10 or 15 years. It's clear that successful investors need to know about China. A long way from China, Europe has a massive and unstoppable challenge. Put simply, people are having fewer children and living for longer. It's expected that the number of workers per retiree will halve from 4 to 2 within a generation. That's a huge change. Politicians and EU bureaucrats can do little to stop or reverse this trend. This means that pension and healthcare costs will keep rising as the population ages, and there will be far fewer working taxpayers to pay for it all. And government debts in Europe are already high at 92% of GDP, and much higher in some individual countries. Plus, the growing number of old people are unlikely to vote for cuts to pensions and healthcare provided by the state. Europe looks set for decades of low growth, higher taxes, social tension, rising political populism, and repeated financial crises, as the debts and spending pressures continue to mount. That's something to bear in mind if you're investing in Europe. Here's something that really surprised me when I found out about it a few years ago. I've been tracking it ever since. Renewable energy seems like a good idea if it's genuinely resource efficient, cheap to produce, and helps to reduce the pace of climate change. Yet, despite decades of government programs, subsidies, and private capital investment, renewable power sources still make up just 3% of world energy consumption. That's the total of solar, wind, tidal, geothermal, and biomass combined. The reality is that 86% of world energy still comes from fossil fuels: coal, oil, and natural gas. Renewable energy production is certainly growing fast, but still from a very low base. In a couple of decades, it could be an important source of energy, reaching 10%, 20%, even 30% of supply. That still leaves the vast bulk to come from somewhere else. The clear conclusion is that fossil fuels are here to stay, and so are investment opportunities in the sector. Let's move from energy to the stock markets. I've seen some outrageous claims that cash payments to investors, or dividends, are as much as 95% of investment profits in the long run. This kind of false claim is easily disproved by looking at the historical record and applying basic common sense. The total return on US stocks averaged 9.5% a year between 1900 and 2014, through all the ups and downs of the market cycles. The return from dividends was under half of that, averaging 4.4% a year. It's a similar picture in all stock markets, not just the US. That's a long way from the claim that dividends are the dominant source of profits, let alone over 9/10. Dividends are certainly important, but don't let yourself be conned into thinking that they are more important than capital gains. You should remember that the next time you're offered an income investment. Now let's look at one of the biggest risks in the world, the ridiculous amount of debt that most developed country governments have. In particular, the huge amounts of short-term debt. When government debt matures and has to be paid back, governments have to borrow new money to cover it. That's on top of new borrowing to cover budget deficits. If interest rates rise, they'll have to pay more to borrow the same amount. Japan is the most extreme example. Its government debts are already close to 250% of GDP and growing fast. But just as importantly, Japanese debt, worth a massive 50% of GDP, matures every year. This means the Japanese government has to borrow around $2 trillion just to stand still. This is one of the main reasons why Japan is a high-risk country for investors. Even if government interest costs only rise a little, the highly indebted government will quickly go bust. For this reason and others, it's difficult to get excited about Japanese investments. Now I'll turn to what I call the ultimate consumer good, gold. One of the amazing things about gold is how little of it there is. Most estimates put it at around 184,000 metric tons. If you put all that gold together into one cube, it would measure just 21 meters, or 69 feet, along each side. That's less than the length of a tennis court. Put another way, if all the gold in the world today was divided evenly between all the world's people, we'd each get about 8/10 of an ounce, worth around $1,000. That's not much jewellery, let alone coins or bars. Especially when you realise that the people of China and India, two huge and fast-growing countries, are already by far the world's largest buyers of gold. I expect them to buy even more in future as their wealth continues to grow. Gold really is a scarce asset, and growing demand is likely to keep driving the price up. Everyone should make sure they own some physical gold. Whereas gold is good, there's something else that looks truly bad. Our era will probably be seen by future historians as the worst time ever to invest in bonds. This is because bond yields, the amount of income a bond owner gets, are at or close to their lowest levels ever since bond markets have existed. Put another way, bond prices are insanely high. Take the case of the Netherlands, which has data stretching back to 1517, or just shy of 500 years. Dutch 10-year government bonds yield just 0.3%, which is by far the lowest they've been in those 5 long centuries. It's the same story across pretty much all developed markets, even if the historical data only runs to 2 or 3 centuries. In fact, around $7 trillion worth of government bonds now pay a negative yield. It's surely insane to pay a government for the privilege of lending to them. At some point, yields will rise again. Bond investors, from pension funds to private individuals, will suffer huge losses as the biggest bond bubble in 500 years is burst. Far from the developed countries with their debt bubble and stagnant economies, poorer countries are busy making money. For example, in 2015, for the first time, there were more billionaires in China than in the USA. In fact, there are now more billionaires living in Beijing than New York. So much for communism. This is an outward sign of the massive wealth creation that's been going on in China. But it's not just billionaires that are being created. From the mega-rich to the middle class, incomes and wealth are rising fast. And it's not just in China either. India, Latin America and Africa also have much faster wealth growth than developed countries. For example, Indian wealth grew 3 times as fast as North American wealth between 2000 and 2015. There will be blips and bumps along the way. It won't all be plain sailing for the world's emerging markets. But the long-term trajectory is clear. Fast-growing wealth means fast-growing consumer markets, and the profits that follow. If you don't own emerging market stocks, then you'll miss out. Part of that wealth boom in emerging markets will come from technology. It's easy to forget, but the internet is still an incredibly new thing. It's only been around in a meaningful way for about 15 years. If you're an internet user, then you're still in a privileged minority. It's estimated that last year only 4 in 10 people in the world used the internet once or more times. What's more, the number of people with regular access, at work, at home, or in public facilities like internet cafes, is even lower, perhaps only a third of the world's population. So that leaves 2/3 of humanity yet to come online, or around 5 billion people. Just think of the huge changes that the internet has brought to your life over the past 15 years. Then you start to realize how much more change is on the way for everyone else. Emerging and frontier markets are growing much faster than developed countries. Technological catch-up is just one powerful driver, and one that savvy investors can profit from. This is yet another reason to invest in emerging market stocks. Now let's move to one of my favourite examples of how perception and reality can really get out of whack. Unfortunately, a huge amount of reporting in the mainstream media is highly inaccurate and misleading. But if you want to be a successful investor, you need much better information than that. Russia is one country that gets a particularly bad press. But if you scratch the surface, the reality is often surprising. For example, did you know that Russia has one of the lowest personal income tax rates in the world? Russians pay a flat tax of just 13% on their income. That's great news for the private Russian economy and consumption growth. In turn, that's a boost for Russian company profits and ultimately the stock market. By comparison, people in most developed countries pay top rates of tax of around 45%, or nearly 3.5 times as much. So next time you read a negative article about Russia, just remember this: the chances are that Russians pay less tax than you. Don't worry, this next slide isn't having a dig at women, but it does highlight an important reason why they need to be careful with their finances. Across the world's countries, rich or poor, large or small, women live longer than men. The gap is consistently close to 5 years on average. This could be down to genetics or to lifestyle, but whatever the reason, it's a global phenomenon. For instance, take Germany, which is a typical developed country when it comes to life expectancy. Boys born today can expect a 12-year retirement. Girls can expect to be retired for 17 years. In other words, the average German woman will be retired for 42% more time than the average German man. This means she'll need to save a lot more money to live on after she's stopped working, at least if she wants to live well and not rely on the state. It's clear that women need to save a lot more than men if they want to live comfortably in old age. And here's one of the biggest problems that all investors must know about. At its root, the massive global financial crisis between 2007 and 2009 was caused by too much debt. Although they deny it now, politicians loved it because it propped up economic growth. But of course it was all a mirage, and the inevitable collapse happened. Were lessons learnt? Yes and no. New regulations mean most big banks are much less risky than they used to be, but still risky in any case. But government debts have gone through the roof as they've continued to overspend, and corporate debt has spiraled in countries such as China and the USA. In other words, the world's total debt burden has continued to rocket skywards, climbing much faster than the economy. More financial meltdowns are certain in future, and we all need to take steps to protect ourselves. Getting some gold is a good place to start. This chart pretty much captures the huge shift of world power that we're experiencing today. The big, advanced imperial European powers reached peak economic share around 1900 and have been in relative decline ever since. The USA's share of the global economy peaked at 28% around 1950 and has been falling since then. The US is still the world's biggest economy with 19% share, but others are catching up fast. In the future, we should expect China, India and others to become increasingly powerful on the world stage. They will have bigger and bigger shares of global wealth and production. This massive change to the balance of world wealth and power is one of the defining trends of our time. It also has a big impact on where you'll find the best investments. Let's get back to energy again, something sitting right at the core of any functioning economy, and therefore how we invest. China's growth has come at a cost. Its cities have a major smog problem, like London in the 1950s or Los Angeles in the 1970s. The simple reason is that over 2/3 of Chinese energy comes from coal, and coal-burning furnaces churn out a lot of smoke. By comparison, the rest of the world gets only 20% of its energy from coal. China now has plans to reduce the amount of coal that it uses. The official reasons given are to cut pollution and carbon dioxide emissions, but the real reason is that China's coal is running out, fast. In fact, China has only 28 years of coal deposits left, at current levels of consumption. China needs to rapidly expand renewable and nuclear energy sources in future. It will also buy much more natural gas from its northern neighbour Russia. But, for now, coal is still king in China. And now, something that certainly surprised me when I first discovered it. Although the USA was a great economic success over the past century and more, and its stock market is now worth about half of all stock markets in the world, it hasn't been the best place to invest in stocks. That crown goes to South Africa, closely followed by Australia. Between 1900 and 2013, investors in South African stocks made 3,372 times their money. That's measured in US dollars, including dividends and on top of inflation. By comparison, investors in US stocks made only 1,248 times their money, which is only 37% as much as South Africa. This doesn't make South Africa the best place to invest in now, but it does show that the best investments are not necessarily the most widely accepted or obvious ones. It's a big world out there. Investors should cast their nets far and wide if they want to find the best opportunities. This little-known chart challenges one of the sacred cows of investing. Throughout history, currencies collapse from time to time. Those collapses are still happening today. The trigger is usually some kind of economic crisis. There's a loss of confidence and mass selling of everything. As panic sets in, assets like stocks and houses become oversold, and often extremely cheap. Investment bank Credit Suisse studied what happened in 24 stock markets between 1976 to 2013 inclusive, and which investment strategies worked best. One finding was striking. Stocks from countries with the weakest currencies in the previous year beat stocks from countries with the strongest currencies by a wide margin over the following 5 years, and all measured in US dollars. This is a reminder that when confidence is at rock bottom in a country, it's very often the best time to invest. Things usually get better, and the profits roll in for those prepared to put their money into play. Here's some more on that crucial energy question, and where it's all going to come from in future. Just 2 countries combined consume 40% of world energy. They are China and the USA. China consumes 22% of the energy, but has 19% of the world population. The USA consumes 18% of the energy, with just 5% of the population. Imagine what will happen in the future if 1.4 billion Chinese and the billions more people in India, the rest of Asia, Latin America, the Middle East, and even Africa one day end up using similar amounts of energy per person as the USA does today. Imagine if it's only half as much. The energy demands would be truly gargantuan either way. Finding new and affordable sources of energy is one of the biggest ongoing challenges facing the world today. That means many opportunities for investment profit. The much maligned Russian stock market has actually performed extremely well over time, driven by fast-growing profits. In fact, since the end of 1994, when the MSCI Russia Index was launched and Russia was still a post-Soviet basket case, Russian stocks have matched the performance of US stocks, both measured in US dollars. This is despite regular market crises, the debt default of 1998, the global panic of 2008, and the oil price collapse of 2014 and 2015. It's also amazing because Russian stocks trade at incredibly depressed levels today, whereas US stocks are right near the top of their historical valuation range. If both markets traded at the same price-to-earnings ratio, then Russia would have outperformed the USA by a factor of 3 since 1994. Given all this, it's a good bet that cheap Russian stocks outperform expensive US stocks in future. Here's a bit more about China. Everyone knows China is an export powerhouse. Its rapid industrialization over the past couple of decades has slashed the prices of a great many manufactured goods that we all use each day all around the world, from clothes to electronics to toys and even cars. But did you know just how big an exporter China is? By US dollar value, China exports 40% more than the second placed USA, even though the US economy is 68% larger than China's in dollar terms. China also exported 45% more than Germany, more than 3 times as much as Japan, and 3.5 times as much as South Korea, the world's other top 5 exporting countries. China really is a force to be reckoned with when it comes to exports of manufactured goods. It may even become more dominant over time. And finally, something really essential for all successful investors. Many people don't trust the stock markets. Perhaps you are one of them. This is understandable since prices can swing around a lot, which makes most people nervous. But in fact, stocks are one of the best things you can invest in, if approached in the right way. A recent and respected study showed that $1 invested in stocks of 23 countries in 1900 would have been worth $325 by the end of 2014, after deducting consumer price inflation. In fact, stocks returned nearly 39 times as much as bonds and 120 times as much as cash over 115 years. Of course, no individual person can invest for 115 years. But your investment career could easily span 20, 40, even 60 years, assuming you live well into your 80s or beyond. So it's clear that stocks should be central to any long-term investment or retirement plan. If you ignore them, then you're missing out on a major source of profits. You'll be poorer as a result. The key is to find the right ones to buy at the right time, which is where Ofwealth comes in. And here's a bonus fact. If you had read past articles from the Ofwealth Investor Thought Club, then you'd already know everything we've just run through, and much more besides, and it's 100% free. Join us as our group of private investors, just like you, continues to explore the world of investment. Armed with great information, profits will follow. To show you what I mean, when you sign up, I will send you a special report on the very best ways to buy gold, the ultimate consumer good. To sign up and get the special report, go to the box below. Once you do this, you'll also start to receive 2 free articles a week written by me about the world of investment. Strategies, opportunities, things to avoid, financial industry secrets, tricks of the trade, you name it, I cover it. I look forward to welcoming you to Ofwealth. Thank you for listening.